Thank you for joining our 2022 Market Outlook webinar. My name is Sammy Azuz. I'm the president of Heritage Financial, and I'm joined today by our Chief Investment Officer, Bob Weisse. Hey, Bob.
Hi, Sammy.
Bob, how's it going?
Going well. It's been a fun week in the markets.
Yeah, I mean, to get things started, I know this is a conversation about our long-term outlook and how people should be investing for years to come. But I'm sure what's going on in the market this month and this week is top of mind for a lot of investors and attendees of this webinar. The S&P is down a little bit more than 10% from its peak on January 4th. Some markets are doing better, some markets are doing worse. What are you seeing in the market these days, Bob?
Yeah, it's interesting. It's something we've been talking about for a while. You see on the fringes, meme stocks, cryptocurrency, and then a little more central, unprofitable tech. And then it goes into tech that you could call maybe a little profitable, but frothy, like a Netflix or Tesla. And the air is coming out of that balloon. So we're seeing those areas get hit hard, really hard. And frankly, it's a good thing we have no exposure to many of those and little to others. But there's a little bit of the baby with the bathwater as well. The overall market's selling off a little bit, but it is concentrated in some of those areas. So as long as you're diversified the way we are, we look at this as normal market volatility.
Great. Okay. And that's an important reminder because I think even though people get sick of hearing this from their investment advisor, this type of volatility is normal. I mean, it's par for the course. You typically see a 10 to 15% correction every year on average in stocks. We didn't see one last year. And I don't think we've seen one since the March and February 2020 bear market. So we were overdue for this level of volatility, and it's just important to stay the course. Don't get rattled. If you're looking for more help on the topic as we pivot to our what we're thinking about going forward, check out the resources that we have at heritagefinancial.net on our blog, talking about protecting yourself from a portfolio in a bear market and some investment themes that we think will reward investors going forward. So, Bob, pivoting to our outlook, which is the topic of today's talk, I was hoping we could share a bit about our investment process. Most major firms share their outlook at the start of the year. Can you share how we develop our outlook? What magic there is, if any, to doing it at the start of the year?
Yeah, it's a great question. So as we lead with asset allocation, believe that asset allocation drives the majority of a portfolio's return. So to start, you need expected risk and return for each asset class. We work with the investment consultant, we work with fiducian advisors to set asset class return expectations across stocks, bonds, real assets. I won't get too technical, but just to give an example, with bonds, 10-year return is approximately the current yield. If you buy a 10-year treasury today and the yield's 175, you're probably going to get 175 if you hold it for 10 years. Stocks, it's a little more complicated. We look at the earnings yield. So for those of you familiar with a price to earnings ratio, P to E, you flip it, E over P, that's your earnings yield. That's the expected earnings you get from stocks. But unlike bonds, stocks grow. So you take the earnings yield, add a growth estimate to it, and that's your expected return for stocks. Now, year to year, you have what's called multiple expansion, contraction. So it's a bit of a roller coaster. Yesterday and today, we're not seeing earnings change, we're seeing multiples move. So that's why we look at a 10-year forecast longer term, because over time, that's just noise. We want to strip out the noise from our modeling. So at the front end, we develop risk and return assumptions, and then we get into what some people would call optimization with some constraints. So basically, to put it simply, trying to put these asset classes together to get clients the best return we can get for a given level of risk. So a client raises their hand, I'm willing to take risk, a certain amount of risk, we take their pulse, and for that risk budget, we want to get the best return possible using the pieces that we put together. We review this annually. So January, there's a standard process. Then over the course of the year, like in March of 2020, of course, we hit it then and review everything as prices change. So that's it. What we're a little bit of a sneak peek, what we're looking at right now is valuations have improved. Stock valuations improved over the course of 2021. Bond valuations improved over the course of 2021. One thing is inflation's picked up. So when we look at markets now going into 2022, we see stocks looking pretty good, bonds actually a little more attractive than they were a year ago. But we're also looking at inflation being higher than it was a year ago as well.
Great. No, thank you for that overview. It's informative and, a little bit of a preview on all of the asset classes. So, let's go in order, maybe starting with stocks first. Global stocks are coming off a very nice 3-year run. They were up 27% in 2019, 17% in 2020, and 19% last year. That's despite a growing list of concerns. You have inflation, supply chain issues, COVID variants, the Fed may be tightening, and now we're seeing some volatility this year. Should investors be worried that stocks are in a bubble that's about to burst?
Yeah, so that's a common question we're hearing, and valuations are high. The returns have been strong. We do think for the most part, this is in a narrow part of the market. So here's a chart. We're looking at the PE ratio of the top 10 stocks in the S&P 500. So this is 2% of the S&P 500 by count. The price to earnings ratio on those companies is 33 times earnings. These are some of the big tech names that you're familiar with, the Apple, Amazon, Microsoft, Google, so that they're at 33 times earnings. You take that 2% out, rest of it's at 19.7, 20 times earnings. Very fair and reasonable valuation for a stock investor. But these companies are big, so it's not just 2% of the S&P 500. Their weight is 30%. These are trillion, multi-trillion dollar companies, so that they do matter. So it is one part of the market that we draw attention to. Following this theme, when we look at 2021 returns, there were a few areas that did well. Large growth, that hits where these companies mainly are. Large value did well as well. We're looking at mid 20% returns. Small value was the best place to be. Our US equity portfolio tilts towards small value and has a healthy allocation to small value. So this helped us deliver strong relative returns last year. Then you look overseas for a global investor, and it wasn't as good. Developed international markets, nothing to complain about with an 11% return, but wasn't in the mid-20s. And emerging markets were actually down 2.5%. So story last year, strong returns in the US. Overseas, not as strong. So you asked the question, okay, well, what about valuations? Are we in a bubble? Is now a good time to invest? This is where we go back to valuations, looking at price to earnings ratios of these markets. And you can see large cap growth stands out. 30 times earnings, that's expensive. So you got a 27% return, but markets are up in valuation there, 30 times earnings. Rest of these bars, these are very reasonable valuations. 15, 16 times earnings for US companies. Overseas, you get a little cheaper. Emerging markets at 12 times, it's reasonable. And what's interesting, this year and even the last couple of days, as we've seen markets pull back, like you see time and time again over the course of a long-term investing career, it's flipped. So year to date, the best bar on this chart is emerging markets. The next best, developed international, and then small cap value. So it's consistent across the bars too. So the worst place to be this year has been large cap growth. Large cap growth is down 12%, while emerging markets are flat. So it's what you see as a value investor. It rewards you over time. Discipline, don't chase the hot dot. It's what we do, and it's been working this year.
Great, and you can see that obviously, and that feeds through to how you're recommending or allocating portfolios these days. So with our stock allocation, what are you looking at just in terms of kind of regional and style breakdown?
Yeah, so we like overseas markets right now. They are cheaper than the US with, as I said, emerging markets, 12 times earnings, value. And also just a follow-up point on the question about market valuations. I know we've used a tagline, oh, markets are cheaper than they were last year. And people are like, how are they cheaper? They're up over 20%. Well, this is what we mean here. If you look at, this is the decomposition of returns. So in the US, earnings growth was quite strong. This bar is showing you the earnings growth. And then down below, what you see is multiple contraction. So this is markets getting cheaper, and earnings growth was so strong that you see a pretty strong diamond up here. So across the world, markets got cheaper. Multiples contracted, while earnings growth was quite strong. So overall, we think this is a good story, but you look, say, in emerging markets where there was more multiple contraction, this goes both ways. Over time, this should zero out. You have some up, some down. Like I said, it's noise. So when it's down, that means the market's getting cheaper.
Got it. Anything else you want to touch on with stocks before we jump over to other asset classes, Bob?
No, I don't think so. It's funny going into this. We said, let's talk about bonds. No one wants to own bonds with rising rates, and then stocks get volatile, and all of a sudden people don't care much about bonds. But let's do it.
Yeah, no, and by way of one housekeeping matter, we're going to try and get you out of here at a reasonable time with still having the ability to answer some questions. So if you do have any questions, please pop them into the Q&A section on the bottom of the Zoom meeting, and we'll try to get through a few of those as we can. So you're right, turning to bonds, which until this week is what everybody wanted to talk about. Stocks, not as much. They have a place in investment portfolios. I know you believe that. I believe that. Most investors believe that. But with the threat of higher rates going forward, should people be worried about bonds? They lost a bit of money last year. Are we expecting more of that?
Yeah, so one of the common questions we're getting is interest rates are going up. Why should I own bonds? And what people, I think, don't understand as much is the bond market, like financial markets, they're forward looking. So when you just stepping back, when you think about the stock market, it bottomed in March of 2020, March 23rd of 2020, and COVID was just starting. So in February and March, the market sniffed it out and said, okay, this is going to be bad. We fell off a cliff. And by late March, we started recovering, and we've had a lot to go. But the market was forecasting, seeing in advance. The bond market does the same thing. The Fed does control the short end of the yield curve. So here we're looking at the US Treasury yield curve. But when you go beyond that, the open markets it set the yield. So we're showing the yield curve at the end of 2020 and then where it was last week. And you can see there's about a 1% increase across the curve, but most of it is in the shorter end where the Fed rate increases will impact the market. So which yield curve do you like better? Which yield curve is a better one to be a bond investor? And now that yields are higher, a lot of the potential increases are priced in. And as a bond investor, you'll get rewarded for it. So it's something that yields are still low. Don't get me wrong. We're not really excited about 1.5% yields. But just stepping back, when we did our capital market assumptions going into 2021, we looked at this and said, bond yields are low. We don't like it. Rates are probably going up. So we did two things. We underweighted bonds. We moved money from bonds to stocks, from bonds to real assets. We shifted our bond allocation into dynamic bond managers who can get a higher yield or on more of the shorter end. So in this term, but buying bonds with credit risk to get yields up here in the threes. And now as we go into 2022, we're really just holding pat. We're looking at what we did last year and saying we still don't like bonds. So we're still going to be underweight, and we're going to stick on the shorter end of the curve. So it's more just our positioning worked last year, moving money from bonds to stocks, and stocks did a lot better than bonds. And we're just sticking with that positioning this year.
So our bonds were slightly positive last year because of our positioning. Do you want to touch on that a little bit, Bob?
Yeah, so we're looking at the fixed income allocation we have here with the split across the bond managers we work with. And here's what's referenced as the US total bond market, typically the Bloomberg Barclays US aggregate index. Effective duration, this is a measure of interest rate sensitivity. For the total bond market, it's about 6.5. We're almost half of that at 3.6. So this is a lot less interest rate risk than the bond market. However, we don't want to sacrifice yield, so we come in around the market yield, a little higher. We do this through working with active management. So you see average credit rating, single A, we're a little below it at triple B, but in working with active managers who we think do an excellent job doing credit analysis, we think that we're able to capture similar yield with a lot less interest rate risk. So
sorry, Bob, I cut off there for a second. So that outlook or that positioning in terms of having lower interest rate sensitivity, but still competitive market yield and credit quality, helped our bond portfolios, and it continues into this year's outlook and positioning.
Yeah, just the one additional point is last year, the yield was higher and credit spreads came in. So despite rates going up a good amount, we were able to deliver a positive return while the total market was down about 1.5%.
Got it. Great. So part of what we did with fixed income is be underweight fixed income, I guess, which is still part of our 2022 outlook and positioning. While we don't want to abandon bonds completely, what are some alternatives that we have invested in and that we think have a strong outlook going forward?
Yeah, it's something we spend a lot of time on. You need bonds to help manage risk, but the returns are low. So we're constantly asking, what else is there? We can't just put it all in stocks. That's too much risk for many people. So we look at other options. And the area we've liked recently is real assets. In real assets, this includes real estate, but it also includes assets like farmland, infrastructure, timberland, a little more unconventional to the average individual investor, but commonplace in institutional portfolios. We're able to invest in real assets through a vehicle structure called interval funds, where they're investing directly in funds that invest in the private investments. So by doing that, by investing in the private investment vehicles, you don't have the mark-to-market volatility that you get with, say, buying a REIT, real estate investment trust, where you're dealing with the whipsaws of the markets. You're not paying a premium for the asset. You're getting the asset, you're getting the cash flow. We look at what we call the building blocks of return, where the asset has a cash flow. So if it's a farm, you own a corn farm that has a 3% yield or so. And then inflation is a natural component. If inflation is 3%, the price of corn goes up 3%, almost by definition. The value of the farmland should go up 3%. You get a 6% return. There are some other things they can do to add 1 or 2% to the return. But through something like that, you get a pretty steady return. And you get that with inflation protection. So when we look at just this chart showing real assets, how they did last year compared to global stocks, they didn't keep up with stocks in a year like last year. We don't expect them to, but you can see the volatility is a lot lower. Below, you see bonds. It is a tough tread to minus 1.5% for US core bond investors. So you can see moving some money from bonds to real assets. While we don't expect spreads like this to repeat, it's an area that we're comfortable moving some of our bond money, and we're talking in the tune of 6 to 8% of the portfolio from bonds to real assets. And in saying that, I just gave you a sneak peek. We're probably looking at increasing our real assets from in the 6% range to the 8% range. That's one of the things we've been talking about internally right now.
Got it. Okay. Well, that makes a lot of sense just in terms of a long-term outlook. One of the questions that we received is Heritage published our 2022 investment outlook recently, which had our capital market expectations. Just what are we expecting generally for risk and return for these different asset classes? Do you mind walking us through just at a high level what those asset class expectations are for returns?
Yeah, they're good returns. They've come up, as I said, with valuations improving. So in the US market, it's approximately 7% for US stocks, using round numbers. You go overseas, developed international around 8, and emerging markets around 9. So about 7, 8, 9, which for equity investors are pretty good returns. And with that, you are taking more risk for that 9% in emerging markets. So it's something we're well aware of. In bonds, you're around 2%. And then real assets, real estate, more middle of the pack in the 5 to 6% range. So what we look at it is pretty good numbers that we can definitely work with, build good portfolios, help clients achieve their financial planning goals and objectives.
Great. And one question that we received that you and I maybe glossed over a little bit is in terms of bonds. We both agreed that you need to own them in your portfolio. They deserve a place in a diversified portfolio. But maybe we didn't touch enough about why, given the muted return expectations and the possibility of rate hikes. Why should investors hold on to their bonds for the next 12 to 24 months?
Yeah. Thanks for bringing that up again. So some people, if you turn on CNBC, they might call the risk on, risk off trade. So when there's risk on, global stocks are doing well. That's a 2021 market, and global stocks doing 19%, US like we talked in the mid 20s. If you're getting 20% on your stocks and your bonds do minus 1.5%, it's still a good year. What you have to watch out for is when it reverses. And even a day like yesterday, although yesterday went down, did a little V, but if you take period where there's the flight to quality. People are panicking. I don't want to lose money. What are they going to do? They're going to buy treasury bonds. They're going to buy high quality bonds. And that's where you go when you want protection. That's where you go when your stocks are going down. And you don't just get the yield, you actually get price appreciation. So the 10-year US Treasury now yielding around 1.78%. That could go back down to 1%. It was below 1% in 2020. And in the environment where stocks are down 20, 30%, you'll do well owning that. So we're not forecasting a 20 to 30% decline in stocks, but that risk's always out there with an equity investor. Otherwise, just put it all in stocks. So it's just part of a diversified portfolio. Most people don't want to put all their eggs in one basket. It provides stability. You also get income along the way. So it's just an important part in a diversified portfolio.
Yeah, so you have directions or themes that you want to reflect in your portfolio, but it doesn't mean you have to go to extremes and just abandon asset classes completely or invest 100% in one direction. The other question that we received that just came in is what kind of risks are there with real assets? Maybe it's an asset class that people are less familiar with than stocks and bonds. What type of risk do you see there in a diversified portfolio?
Yeah, the risks, I guess they are lower because the returns are lower. We're showing a strong year here, but we're looking more, like I said, that 6% return. And if inflation slows down, almost deflation, then all of a sudden, expecting, like I said, corn to go up 3%, and if you say it's going to go down, that there's an issue. Multiple contraction within those assets. So if people are willing to pay less for them, but overall, that is why we like them. It's a cash flow story. You're in there to clip coupons. It's not a get rich fast story. And get rich fast, that goes both ways. Earn a 3% coupon plus inflation. That's why we like it, and that's why you don't see the volatility here. Like in Q3 last year, risk was happening, markets were going down, real assets, it didn't bother them. So in 2020 in March, real assets went down just a couple percent. So it is just a strategy that's lower volatility ultimately, and that's why we like it.
Got it. That makes a lot of sense. Is there anything, Bob, in winding down or wrapping up that you want to share about our outlook or investments that we haven't touched on yet?
The one other thing that maybe expands on this topic, and it's not for everyone, is private markets. We're looking at private markets that we can access through an interval fund here. We also like private equity in some areas, but that is for qualified purchaser investors. But with private equity, you're taking control of the company. You're working with a firm that takes control of the company, can add value strategically, operationally, and it's just a way to get a better return. So that's another area that we've spent a lot of time looking at opportunities over the last year and a half.
Got it. No, that makes a lot of sense. And the way I've been explaining kind of our investment outlook in meetings is a lot of continuation of the same themes from 2021. Just because it's a new calendar year doesn't necessarily mean you completely change your outlook. Some of the themes that did well in 2021 should continue to be the way you're positioned this year. Would you agree with that?
Absolutely. Yeah, that's what I was getting at with bonds. It's not reinventing the wheel. We look at it and the story's about the same. Bonds, while yields are up, they're still not that attractive. Stocks look good. There are opportunities in real assets. So for the most part, we're not going to be making many changes. The story hasn't changed very much.
Got it. All right. Well, thanks, Bob. And to all of you, thanks for coming and attending our webinar. The last question that we received was whether there would be a replay available. Everybody who did register for the webinar and provided an email address will receive a replay and a recording. If you need more information or more help along the way, please make sure to subscribe to our blog at heritagefinancial.net. If you aren't working with us already and would like an assessment of how your portfolio is positioned, given these themes and this outlook, please reach out to us. Thank you very much for joining us today.